Have you ever had one of those trades, the one that looks absolutely perfect, a textbook breakout, and then it just completely turns against you in a heartbeat? It is one of the most frustrating feelings in trading. Well, today, we're going to pull back the curtain on exactly why that happens. We're going to dive deep into the market maker's playbook and see how they use those obvious chart patterns to set the perfect trap. Welcome to AI Explains ICT. In this video, we are digging into some of the absolute core concepts from the Inner Circle Traders material, specifically Month 2, Episode 8. We're going to get right into the nuts and bolts of how price is really delivered in the market. So let me ask you, does this sound familiar? You see a beautiful consolidation, you place your breakout order, you watch price smash right through your entry, and then, boom, it slams back in the opposite direction and takes you out for a loss. If you're nodding your head right now, trust me, you are not alone. And there is a very, very specific reason it keeps happening. So here's our game plan. First, we'll look at the classic breakout trader's trap. Then we'll shift our perspective and learn to think like a market maker. After that, we'll dissect the anatomy of a liquidity hunt, figure out how to ride the smart money wave, and finally, uncover the market's true motive. All right, let's kick things off with a story that's probably way too familiar for many of us, the breakout trader's trap. This is really chapter 1 in most retail traders' journeys. The classic trading books all teach the same thing, breakout trading. And the idea sounds pretty solid, right? You find a nice, clean range where price is just bouncing around, and you bracket it. You stick a buy stop order above the highs, a sell stop order below the lows, and the thinking is, hey, whichever way it breaks, I'm ready to catch the new trend. But here's the catch. When thousands and thousands of retail traders all do the exact same thing, look what happens. Those buy stops and sell stops, they aren't just orders anymore. They become these huge, predictable pools of money just sitting there. And this liquidity, as we're about to see, is the exact target the market is designed to hunt. And this brings us right to the core lesson from ICT. If you want to stop falling for the trap, you have to stop thinking like the person about to step in it and start thinking like the person who sets it. It's time for a major paradigm shift. So here's the fundamental difference. The breakout trader is totally reactive. They see price move and think, oh my gosh, I got to get in, I'm missing it. But the market maker, what we call smart money, they're proactive. They're looking at the board and asking a totally different question. Where are the orders? And then they engineer price to go to those levels. They aren't reacting to the breakout. They are literally causing it. Okay, so this is probably the single most important definition we're going to cover. When you hear the word liquidity, forget all the complex economic jargon. In this model, it is incredibly simple. Liquidity is the fuel that makes the market go. It's those big pools of buy stops above old highs and sell stops below old lows. That is the target. So, enough theory. Let's actually see this playbook in action. We're going to walk through the anatomy of a liquidity hunt, step by step, on a real chart. Okay, check this out. We've got our consolidation range. Now, what's the first move? In this bullish example, they drive the price down. They smash right through those sell stops at the bottom. This is the trap. While retail traders are frantically selling the breakout, smart money is on the other side of that trade, quietly buying up all those sell orders and building a massive long position at a fantastic price. So what happens next? Well, now that their bags are full, they aggressively reverse the price and send it flying in the opposite direction. And what's their target? You guessed it, the other pool of liquidity, all those buy stops resting above the high. As price rockets up, all the breakout buyers give smart money the perfect opportunity to sell their long positions for a massive profit. It's genius, really. They bought low, and now they sell high. So we can actually break this down into a simple, repeatable formula. Step 1. Price consolidates, which builds up all those orders on both sides. Step 2. In a bullish model, they raid the sell-side liquidity below the range. That's the false move. Step 3. Price expands aggressively upward. And step 4, it hunts the buy-side liquidity above the range, which was the real target all along. And make no mistake, this is not a one-time trick. The market is a creature of habit. After that first run, what does it do? It consolidates again, building up fresh pools of liquidity. And then the pattern just repeats itself. A little dip to hunt stops, followed by another aggressive run higher to the next logical target. Those beautiful, obvious, clean highs where even more buy stops are just waiting. You can just see this cycle of accumulation and distribution so clearly on this chart. The blue boxes, that's where smart money is buying. They engineer those dips specifically to get in at a discount. And the red boxes,
That's where they're selling, running price up to those premiums to cash out. It's a beautifully elegant and simple model once you know what you're actually looking for.
Okay, so understanding the problem is one thing, but how do we actually use this knowledge? That's the important part, right? This section is all about how we stop being the victim and start riding the wave with smart money.
You've heard that old saying, if you can't beat 'em, join 'em. Well, that is precisely the goal here. We are not trying to fight the market makers. We are simply trying to align ourselves with what they're most likely going to do anyway. So how do we actually do that?
All right, here's your new game plan. First, you identify a clean consolidation range. Second, and this is the hardest part for most people, you wait. You let the market make its first move. You let it run the stops on one side, but instead of seeing a breakout, you see it for what it truly is, an accumulation phase. And then, and only then, you can anticipate the real move toward the liquidity on the other side. At the end of the day, it's a total mindset shift. You have to stop trying to fight the algorithm, stop trying to predict every little wiggle. The real goal is just to understand the market maker's primary motive, which is to seek liquidity and get in line with it. You want to swim with the current, not against it. And that brings us to our final and honestly our most important principle. This is the one idea that once you truly get it, will change how you look at a price chart forever. So what is the market's true motive? It's this, straight from ICT, the market will always seek liquidity. That's the number one driver in price action. It's not about trend lines, it's not about indicators. The market algorithm has one primary directive: go find the largest pools of orders and engage them. That's where the business gets done. So, I'll leave you with this challenge. The very next time you open a chart, I want you to force yourself to see it differently. Stop looking for breakouts. Start looking for liquidity. Ask yourself one simple question: where are the stops? Because that's almost always where the price is going next. Hey, if this breakdown of the market maker model helped you out, do me a favor and hit the like button and subscribe for more explainers like this one. If you have any questions at all, drop them in the comments below and a human will get back to you. Stay safe out there and happy trading.